Hello, today is Wednesday, February 24th, 2021, and thank you for joining me for another edition of the Market Commentator Podcast. My name is Andy Wilms, and I'm the President and CEO of the Milwaukee Company. Joining me this morning is Dimitri Delis, Senior Economic Macro Strategist and Managing Director of Pieper Sandler Financial Strategies. Thank you for joining me today, Dimitri.
It is my pleasure, and thank you for having me.
It's my pleasure. And today, Dimitri and I will be discussing the post-COVID U.S. economic environment. But before we get started, I'd like to remind you that this podcast is for informational purposes only, and listeners should conduct their own independent research before acting on any information or opinions expressed during this podcast, and that the views expressed in today's podcast are my and Dimitri's personal views and not those of the Milwaukee Company or Pieper Sandler. Dimitri, it appears that there is reason for cautious optimism that the worst of the COVID-19 pandemic in the U.S. may have peaked. If so, what do you think this will mean for the U.S. economy in the months ahead?
Well, I believe that the worst is over in terms of the pandemic as well. I mean, we have the vaccine that has been distributed. It comes and goes with problems, but eventually we will get that job done as well. But in terms of the economy, we have seen the worst. We saw it back in March when pretty much every category bottomed, whether you looked at retail sales, you looked at ISM manufacturing, you looked at personal spending, housing, they all hit a bottom back in March. And since then, we had a very sharp V-shaped bounce. And the thing is, how can you not have such a very sharp bounce when we spend so much money, monetarily and fiscally? I mean, for example, we had the 2.2 trillion CARES Act go in the economy. We had another $900 billion that was passed in December. I mean, I would start questioning that something is wrong if we didn't get a big bounce like that, given the amount of money that we put in there.
But, yeah, I agree. The one area we probably haven't seen as much recovery as you and I would like is in consumer confidence.
Yes, we have not. And that's the one thing that I would caution. You need to get more traction on that side. Why is that important? Well, because the consumer represents 2/3 of GDP. 2/3 that goes to measure the broadest measure that we have in the U.S. or any other, or for that matter, any other country, how they measure it. I mean, you need to get traction from the consumer. And right now, the levels that we see for the consumer are still below pre-pandemic levels. And the reason I think that is because the consumer is still cautious in terms of how well the vaccine will take effect. I mean, is it going to be effective 6 months, 9 months from now? And of course, the other big problem that I think is out there is we have still very huge levels of unemployment out there. I mean, right. If you look at the way the government measures the unemployment rate, I mean, they're telling us unemployment is at 6.3%. That corresponds, I believe, to about 10 million people that are still unemployed. But the problem with that is the unemployment rate is much higher because they don't capture in their surveys how many people are still unemployed and they are receiving benefits from other programs, from programs that were set specifically for the pandemic. If I take all those folks into account, the ones that are receiving benefits from regular state programs, as well as from the pandemic established programs by the government, as well as extended benefits, there's over 20 million people right now receiving benefits. So the unemployment is still high out there. And of course, I mean, what drives in my mind for anybody confidence is jobs. I mean, for me, for example, if I lose my job, I have no confidence. I won't spend any money. If I feel like I'm losing my job, I won't spend money. So that's where we need to get traction. We need to get those jobs back going.
I couldn't agree more. And, but there's also been a lot of discussion about the fact that state and local governments have been hit hard. I mean, and that whether the reality of that is perhaps open to debate, but there's been a lot of politicians arguing that the states need to be bailed out to some extent. Do you share that view?
I don't share that view at all. I mean, there might be certain states specific to them that they may have problems because of the pandemic, but on an overall basis, I think the states are doing just great. And the reason I'm saying that is because they got a huge infusion. First of all, two things here. If you look at their total revenues, where they get them from two sources. They get them from taxes, and they get them from the federal government. If you look at their tax revenues, and I'll talk about that in a second, They didn't fall. Their tax revenues remain on track. And I'm talking about for all 50 states on average, looking at them holistically. And if you look at the amount of federal aid that they got, it's unprecedented. Right now, they have more revenue. States have collected more revenue in 2020 and in 2021, pretty much, than they ever have had in the past. I mean, if you look at the revenue side, for example, let's see why revenues are not that bad. I mean, tax collections are not that bad. What kind of tax collections do they have? They have income taxes, they have sale taxes, property taxes, and of course, they do have also corporate taxes. Now, income taxes, they hardly had a miss there. Only a mild shortfall, and now they're recovering. Why? Because first of all the losses in jobs were concentrated in low-wage jobs. White collar jobs, people didn't lose that many there, and those were the high-paying jobs. The stock market remains resilient, so capital gains are still pretty strong. And if anything, we had stock market gains that are unprecedented. So capital gains will be unprecedented as well, and taxes on that will be unprecedented. And unemployment benefits, remember, people did receive unemployment benefits, a lot more, for example, than they were employed. For example, what do I mean by that? If you look at how much, when people lost their jobs, or when they usually lose their jobs, they get about $400 a week on average. And they come from the state. But right now, they got also an additional $600 of extended benefits. So basically, they were making $1,000 a week. $1,000 a week, that's $52,000 a year. I can tell you, somebody that's making $15 an hour, and if you were to annualize that, you're looking at about $30,000 a year. Right now, they were making almost twice as much being unemployed. If before they were making $15 an hour, which is the minimum wage, and now, or the supposedly what we're proposing to be the minimum wage, and now they're making $52,000. They were making almost twice as much. And remember, unemployment benefits are taxed, so there was no loss in income taxes.
Right. And so we've seen a shifting of some of the fiscal burdens that are normally onto the states and taken on by the states, shifted to the federal government. And I agree with you that there hasn't been as much distress at the state level as some people would like to suggest. And I think that's been has been made evident, Dimitri, in the way municipal bonds have been holding up in here. Would you agree with that?
Well, I agree. I agree. I agree with the fact that, not all states have been hurt. Most states have not. I mean, obviously there are areas or states that have been hurt. For example, if you look at Nevada, Las Vegas, Florida, I mean, they did Disney the World. They did suffer from tourism. This pandemic has not hit the goods producing sector as much. Well, it didn't hit at all, the goods producing sector, as much as it hit the service sector. So in restaurants, entertainment, and obviously tourism, those are the things that got hurt. Right. And of course, the social distancing measures, in my view, continue to remain in place. And we will probably have that with us for a while. For a while, I think those industries will continue to get hurt. So some of those states will get hurt. So and they will have those issues. But in terms of the bonds and the fact that they're so tight, like you mentioned, that's a good indication. That the states are doing better. But also on this front, I also want to mention one more thing, because yes, states might be doing better, but I think the fact the Fed has injected so much liquidity in the system, it is covering all types of problems that might exist out there.
Right. Now, there may be, we mentioned all the money that's being pushed into the economy by the Fed. The question becomes then, is all of this, new stimulus going to result in inflation? I mean, we've seen a massive increase in the amount of the money supply, and historically, if you have the money supply growing faster than GDP, you have an inflationary environment. What's your perspective on inflation?
Well, the thing is, the questions you have to ask, Andy, is why? Why did the money supply grow? Usually, money supply grows, it grows when your savings account goes up and people save more money. And the question is, why did the savings accounts go up? Well, because remember, a lot of people remember, besides also getting extended unemployment benefits, people started making more money because the government was giving that money out. Remember, there was also stimulus checks, $1,200 that each person in the U.S. got, even if they hadn't lost a job. People that were making all the way up to $150,000, even if they hadn't lost their jobs, they weren't impacted by this. They still got $1,200. So the government gave lots of money out there. And at the same time, while the government gave all that money out, what did the government do? They shut down all the places where we could go spend it, with the exception of Walmart and Costco. So what did people do with that money? They stashed it. They put it into their savings account. So
right.
That's what happened. And the same thing with corporations. They felt very unsafe and uneasy. So what these corporations did during that time, they went and they tapped into their credit lines and borrowed money. So they took out loans, not because they thought they were going to invest and expand their industries for more profit, because they were insecure in what the future was holding for them. So that's why the money supply went up, because they were just stashing money away.
So we've seen that even though the government's been injecting a lot of liquidity into the system, the actual velocity in that, the pace at which that money circulates through the system has not accelerated or has not kept pace, because so much of that money has been, put into savings and in the bank accounts and whatnot. But my concern is that money isn't going to sit in savings and bank accounts forever. And so while we haven't seen any immediate inflationary impacts, I think inflation, there's prospects for inflation increasing significantly in the months and the years ahead. And we've seen that manifest itself, that possibility of manifests itself in the 10-year rate and other, interest rates rising substantially since the beginning of the year. So I'm not saying inflation is coming down today or tomorrow, but looking a little further down the road, in the months and years ahead, I think there may be a very high price to pay for all of the money that's been injected into the system, because eventually that will work its way into the inflation rate.
Well, you're right.
I mean, but it's just there's more than one way to look at it, I'm sure.
Yeah. Oh, no, you're absolutely right. I mean, when you throw this type of money out there in the system, it does raise the risk. I mean,
right.
A lot of money out there could be a problem for inflation. But as you mentioned, the money velocity is still at very historical low levels. It is actually at historical low levels.
Right.
Back all the way to the Great Depression, you can't find even a lower level than where we are right now, which means, the money's not coming out.
Do you think people are going to leave that money in their savings accounts forever? Or is it eventually going to come out,
No, it's not. Eventually, they will spend it. You're talking about inflation. Yeah, we probably will see an uptick in inflation over the next few months. And probably inflation could go up to 3%, maybe 3.5% from where we are now. Why? Because, first of all, you're going to see base effects. And by base effects, you're going to make comparisons with last year this time to this year. Last year, everything was dropping. So we had a huge drop in prices. So that's going to create now the impression that inflation has picked up. But again, we call this a base effect because it's related only to what happened last year. Once that base effect goes away, I think the inflation numbers we're going to start getting are going to be more normal. Now, I don't think inflation in the long run, despite the fact the Fed has that so much money has been spent out there, that it's going to be something like a runaway inflation. And the reason I'm saying that is because, remember, we have been living in a very disinflationary environment for the last 30 years. You have seen inflation. You have seen the 10-year rate come down for the last 30 years. Why has it been coming down? Remember, we have aging demographics. You have automation. You have too much debt out there. You have globalization. Those are forces that have been playing out, and I don't think they've run their course.
Right. I agree that those are all forces that have held inflation in check up till now, but we've never had this amount of liquidity injected into the system. Sooner there's a limit, unless you believe in modern monetary theory, which would argue there's no need to worry about inflation virtually no matter what the federal government does. I'm not a believer in that. I think you have to, accept there has to be some recognition of the fact that if the government interjects all this money into the economy, and eventually, and there's not a corresponding increase in GDP. That's the big catch in my mind. Unless you can offset it by GDP, you'll have growth. You'll have more money chasing fewer goods or the same number of goods. That ultimately will lead to long-term inflation, not at the rates. I remember when I was first, when I bought my home and paying a 12% mortgage, but I don't think we'll get there. But I do think we'll see inflation become more of an issue. And I think it's a good thing for investors to keep in mind, and when they decide how they're going to be positioning their portfolios for the long term. For short-term traders, it's not as much of an issue. For long-term investors who may be considering whether or not they should be investing in long-term bonds or other, or maybe tips as an alternative. These are the inflation down the road, I think, is something that ought to be kept in mind. So, but let's move on to equities and talk a little bit about that. There's been an opinion that equities have gotten too expensive. Every time you turn on Squawk Box, you hear somebody come out there and say, the market gurus. There's someone arguing that a stock market correction is forthcoming. Do you see that in the cards?
It's not a matter of if the correction is coming. It's a matter of when. There's no doubt in my mind that there's a correction coming. Look, if we look at the fundamentals, and I'm talking about earnings. If you look at the PE ratio of the S&P, it's at a historical high right now. If you look at the, for example, one of the favorite measures that I use, for example, is I take the value of the S&P and I divide it by hourly earnings. And by wages, pretty much. And basically, it tells me how many hours does the average American need to work in order to buy one share of the S&P. So if you do that right now, you take the S&P value, divide it by hourly wages. The average American has to work over 140 hours to buy one share of the S&P. 30, 40 years ago, they had to work less than 20 hours. To me, that is a very strong indicator that this market is overvalued. And when you look at the Buffett indicator, where the Buffett indicator is you're comparing the value of the S&P relative to how fast our economy is growing. Right? It's at a historical high. Even when you compare it to corporate profits, there's a mismatch there. Right. Any value metric that you look in the past that people have been using for the last 40, 50 years in order to conduct their decision in terms of where to allocate money in the equities suggests that this market is overvalued and it should correct. And some of the indicators that I have here say the S&P should be closer to 2,000, not to 4,000 where it is right now. But having said that, even though all these fundamental ones are pointing at lower equity valuations, there is one indicator that is pointing to higher equity valuations. And what that indicator is not your traditional fundamental that people have been using. It's the Fed's balance sheet.
Yep.
The Fed's balance sheet, if you were to look at a chart where it shows how the S&P has been growing over the last 10 years and how the Fed's balance sheet has been growing, you can see that there's been a really nice connection, a nice correlation. And that correlation becomes even stronger when you instead of only looking at the Fed's balance sheet, you look at all the central banks' balance sheet growth together. You look at the US, you look at the Europeans, you look at Japan, you look at the Bank of England, you put all those balance sheets together. You look at how fast they've been growing, and you look at our equity valuations, you will see they've been going up 1 for 1. So,
well, I think your point is very well taken, Dimitri, that it's not a question of if, but when the market will correct. And that's the whole problem with trying to time markets, and why I've advised my clients that trying to time the market is.
Let me tell you one thing that I find interesting. Back in 2000, that was my first time I saw the market crash. I didn't know before that what it was. I thought the market always goes up, and I remember that time I used to go into somebody's cab, get a ride, and cab drivers would give me a tip and tell me where exactly to invest money. And at that time, you knew that there's something wrong, that since you're getting tips from somebody that is not in the field and they're telling you where to invest. Let me ask you, do you know now who is giving me tips?
Well, people online primarily.
Well, not well. I'll tell you what. I'll tell you who gave me a tip. I think it was about a month ago. It's my daughter. She's in eighth grade. She's in eighth grade. She told me, Dad, why don't you buy Pinterest? And we're going to make a lot of money. And I go, and we did buy. We bought 10 shares of it. And obviously, she's pretty happy because she's been making money. And I go, where'd you get the tip? She goes, I heard on TikTok. I read it on TikTok.
Yeah, that's exactly what I'm talking about. The social media influence. And, that is a partial reason why the market could continue to go higher, because there is this, there's a lot more money people have to invest, well, not a lot more, but you have the average investor who's gotten a lot of this government stimulus that may not have spent it, that can invest some of that money. And, historically, surprisingly, if you look at when the market's at an all-time high, it's significantly more probable that it will go up than go down from all-time highs. So it's kind of counterintuitive. But I guess I'll wrap up by saying, the one thing I think not debatable, and that is as stocks become more expensive, they also become more risky. In other words, and right now, I think you and I both agree that stocks are more expensive than they probably have ever been before on a valuation basis. So investors who are looking to keep a consistent level of risk in their portfolios, which is really how you should approach it, I think. If you're looking to keep a consistent level of risk and the risk of the equity component of your portfolio has increased, then you need to look at ways to lower that risk so that you're not taking on more risk than you originally intended. Well, with that, Dimitri, I'm sorry to say that we have run out of time here. It was a fascinating discussion, and I would hope I can get you back again sometime down the road here.
Absolutely. It was my pleasure. Thank you very much.
Thank you. And let me just wrap up by telling our audience that they should please keep in mind that they should not act on anything they've heard in this podcast until they have discussed it with a qualified financial professional who is familiar with their personal situations and their investment objectives. And with that, I'll say thanks again, Dimitri, and everybody listening. Have a great day.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.